Welcome to The Explainer. I'm absolutely thrilled to guide you through today's topic because, honestly, we are looking at one of the most fascinating corporate thrillers in modern tech history. So, let's set the scene. It's the summer of 2026. Alphabet, the parent company of Google, finds itself standing squarely at a crossroads, facing this massive, mind-bending paradox. On one side of the ledger, they're pulling in record-breaking revenue and showing absolute AI dominance. But on the flip side, they are facing unprecedented spending, historic internal upheaval, and some very sudden investor panic. It's a defining moment, not just for Alphabet, but for the entire future trajectory of artificial intelligence. Okay, let's dive right into this because this number is where our story really kicks into high gear. $180 billion. That is the staggering amount of market value Alphabet lost in a span of just 3 weeks. Think about the sheer scale of that for a second. I mean, entire industries aren't worth that much, and it just vanished in less than a month. To understand exactly how a tech titan bleeds that kind of value so rapidly, we have to take a look inside the company walls. Which brings us to Section 1, the brain drain and the leadership shakeup. On August 5th, 2026, Alphabet announced a sudden and seismic overhaul of its entire artificial intelligence division. Notice this really fascinating shift in focus for Demis Hassabis. You know him, the Nobel Prize-winning face of Google's AI efforts. Well, he announced he was stepping down from his day-to-day managerial role. Instead, he transitioned to chairman of DeepMind and chief scientist of Alphabet. Why? To focus on long-term strategy, curing diseases through isomorphic, and achieving artificial general intelligence, AGI. He even stated he felt AGI was, quote, close at hand. Now, to fill that managerial void, Kore Kavakuchioglu, DeepMind's chief technology officer, was promoted to take over day-to-day operations. But Hassabis stepping back, that was just the first domino to fall. That shakeup triggered a massive exodus of foundational talent. Jeff Dean, a 27-year veteran and Google's chief scientist, walked out the door. And he didn't go alone. He took an absolute all-star team with him. His engineering partner of 2 decades, Sanjay Gaimawat, Gemini co-lead Oriol Vinyals, and Google Brain founding member Kwok Le. This isn't just regular corporate turnover, this is literally the architectural core of Google's AI brain trust leaving the building all at once. Their destination? A brand new public benefit startup called Discovery Loop, completely focused on automating scientific research. But here's the ironic twist that makes this such a complex corporate thriller. Alphabet didn't just wave goodbye. They actually became a founding investor and the exclusive cloud partner for Discovery Loop. Alphabet is essentially funding its own brain drain. They're keeping their departing geniuses incredibly close. But you know what? The market did not care about that silver lining. The stock tanked 4% on this news alone, completely erasing that $180 billion we talked about a minute ago. To really grasp why the market reacted so violently to that talent exodus, we need to shift our narrative over to the financial ledger. Section 2, the trillion-dollar illusion, Q2 earnings. Just 2 weeks before the leadership shakeup, Alphabet reported what initially looked like a blowout quarter. On the surface, the numbers were spectacular, especially in the cloud. Google Cloud revenue didn't just grow, it accelerated dramatically. It went from 63% growth in Q1 all the way up to a massive 82% growth in Q2, pulling in $24.8 billion. Operating income for the cloud more than tripled, and perhaps most impressively, nearly 90% of the Fortune 100 are now actively using Gemini Enterprise. The underlying business of selling AI infrastructure was absolutely booming. Then came the headline number. Alphabet reported a jaw-dropping net income of $112.1 billion, up 298% year over year. But if we take a closer look, it reveals a bit of an illusion behind that massive figure. The vast majority of that income wasn't actually from selling ads or cloud space. $99 billion of it was simply a mark-to-market accounting gain. It was an on-paper revaluation of Alphabet's equity stakes in companies like SpaceX and Anthropic. It looked like they were printing cash, but it wasn't operational profit. Meanwhile, the actual cash they were spending was astronomical. Alphabet raised its 2026 capital expenditure forecast to a range of $195 to $205 billion. Let that sink in for a second. That is roughly double the $91 billion they spent just 1 year prior in 2025. This is the staggering cost of building out the data centers and buying the chips needed to train the next generation of AI. And that incredible spending spree delivers the punchline of our financial paradox. Because despite those record revenues, spending $44.9 billion on capital expenditures in Q2 alone pushed Alphabet into negative free cash flow for the very first time since its initial public offering in 2004. For over 2 decades, Google has been one of the greatest cash-generating machines in the history of capitalism. But suddenly, more money was going out the door to build AI infrastructure than was coming in from their operations. Which naturally leads us to ask this very direct question. If you're Alphabet and you're suddenly cash flow negative, how do you actually fund a $200 billion AI arms race without draining your reserves completely dry? Well, the answer lies in their next major corporate maneuver. They decided to leverage their pristine balance sheet. Section 3, borrowing billions for the AI boom. On August 6, literally just a day after the leadership shakeup, Alphabet hit the bond market looking for $25 billion, and Wall Street's appetite for Alphabet's debt was absolutely voracious. Investors placed $115 billion in orders. That's an oversubscription of 4.6 times. People were lining up around the block to lend money to Alphabet, allowing the company to raise up to $170 billion in fresh capital in less than a year. But we have to zoom out to contextualize Alphabet's spending here, right? They aren't doing this in a vacuum. Big tech as a whole, we're talking Amazon, Meta, Oracle, Alphabet, is expected to spend over $730 billion this year alone on generative AI and data center construction. It is a full-blown gold rush, and no one can afford to stop digging, no matter how much the shovels cost. Fortunately for Alphabet, all of this spending is offset by a massive silver lining on their balance sheet. Let's move to Section 4, the Anthropic Bonanza, a virtuous cycle. Let's walk through this brilliant cyclical strategy together. Step 1, Alphabet pours massive capital, adding about $10 billion in early 2026 alone into the AI startup Anthropic. Step 2, Anthropic uses that capital to grow its Claude language model, which then completely explodes in usage and valuation. And then step 3, here's the real genius part. Anthropic then turns around and commits to spending $200 billion on Google Cloud over 5 years. So Alphabet's investment essentially guarantees their own future cloud revenue, creating this perfect virtuous cycle. Because of that virtuous cycle, Anthropic's overall valuation approached $96.5 billion. That makes Alphabet's 14% stake in the startup worth roughly $124 billion as of June 2026. It is easily one of the most lucrative strategic bets in the company's entire history, and it provides a massive cushion against their own cash burn. However, no corporate thriller is complete without a wild card threat. While the tech and the financials are locked in an arms race, Alphabet is facing mounting legal battles that threaten the core of their social media dominance. Section 5, Legal Clouds on the Horizon. On August 10, the 9th U.S. Circuit Court of Appeals allowed thousands of lawsuits against Google, Meta, and others to proceed. Now, to be clear, and looking at this completely impartially based on our source material, these lawsuits, which are filed by schools, states, and individuals, allege that these tech platforms were intentionally designed to be addictive, which they argue contributes to surging youth mental health issues like anxiety and depression. The courts have basically ruled that these tech giants must now face these claims in front of a jury. To really grasp the scale of this exposure, let's look at the timeline. In March 2026, a jury actually handed down a $6 million verdict against Google and Meta regarding platform design. Then in August, the appeals court cleared the way for 2,400 federal lawsuits to move forward. Add to that the roughly 3,300 state lawsuits currently pending. Even for a giant like Alphabet, thousands of ongoing trials represent a massive operational and financial distraction right at the exact moment they need total focus on AI. Which brings us to the conclusion of our overarching narrative today. We have to weigh these incredible risks against the unbelievable rewards. Section 6, the ultimatum. Dominance or bust? So the crucial point really comes down to this historic balance sheet. On the asset side, Alphabet is holding absolute powerhouse cards. 82% cloud growth, $124 billion stake in Anthropic, and 950 million active AI users. It's an empire of totally unprecedented scale. But the liabilities are just as historically significant. Their top foundational talent is defecting, they've posted negative cash flow for the first time in 22 years, and they're staring down over 5,700 pending lawsuits. And what is truly fascinating is how the market is interpreting this paradox. By mid-August, Alphabet's stock closed at $350.52. That is over 41% above its estimated fair value. Think about what that means. Wall Street isn't waiting to see if Alphabet can execute a turnaround. They are already pricing in total, undisputed AI domination. The market essentially believes the assets will completely overwhelm the liabilities. Which leaves us with this final, incredibly high-stakes question to ponder. Can Sundar Pichai and his team actually convert hundreds of billions in AI spending into lasting, sustainable profits before the mountain of debt, the brain drain, and the legal challenges catch up to them? Alphabet has the absolute firepower to win the AI arms race, for sure. But at $350 a share, there is zero margin for error. Thank you so much for joining me for this explainer. I really hope this helped unpack the fascinating complexities of Alphabet's defining moment.